We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Inflation slows, but it's all about the banks today. Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and with me today is Chris Calandra from Elliott Wealth Management for this edition of our Wallet Watch segment. And Lord knows there's a lot going on with your money you need to know about. Chris, welcome.
Yes, this is very true. It's not like we had to work hard to come up with something to talk about for today's Wallet Watch segment. A lot going on. So you want to start with Silicon Valley Bank?
That's where it all starts, yes.
So let's just make sure we're all on the same page. It's the 16th largest bank. It failed last week. It's the second biggest bank failure ever. It's a classic run on the bank, Eric, with a modern twist. The bank is unique for a few reasons. Over 50% of venture capital firms are estimated to have used Silicon Valley Bank, and 90% of its accounts were over the traditional $250,000 FDIC limit. That's pretty unusual. They were very concentrated. The bank was very concentrated in the startup, VC-funded, smaller tech world, very concentrated. And that set the stage for the twist with the run on the bank. They were known to make loans that other banks would not make because of this very close working relationship that they had with the venture capital, internet, or tech startup universe. So that's kind of a little bit about the bank. So they were a victim, the bank was, of the most aggressive Fed rate hike action ever. It's often said that when the Fed acts strongly, they tend to break something, and it was difficult to predict what was going to get broken, but Silicon Valley Bank seems to be what got broken. They really manage risk poorly. I think it's important for everyone to understand that's listening, is that they take deposits in, and then they pay short-term rates to the depositors, and then they take that money and deploy it to try and get a return better than what they're paying their depositors. They manage their risk very poorly. They owned and were heavily weighted in their portfolio to 10-year treasuries and 10-year mortgage-backed securities. These are low-risk instruments that are guaranteed to pay off at the end of the 10 years. But, and this is very important, with interest rates going up a lot last year and this year as well, the value of those bonds were down. And so when they needed to sell them, because their portfolio, their asset base, their depositor base was struggling, they needed to sell those. They couldn't hold them until the 10-year maturity where they would be fine. They had to sell them at a loss. And it just created this cascading effect. It's kind of inexplicable that they managed their risk so poorly because they didn't adjust to what everybody knows is a very inflationary environment. This is no surprise. We got to 40-year highs on inflation. And what happened, Eric, is that the venture capital companies moved money quickly, and they recommended to their portfolio companies to move out quickly. So you had something like 25% of their asset base got moved in some 24 to 48 hours. Just a massive outflow. That's the twist, that the venture capital firms moved their money, and then they told their clients, 10, 12, 15, 20 portfolio companies that they have funded to move to. So it really sped up the race to the exits. Very much a leadership failure for the bank. It's not fraud. It doesn't seem to be fraud. It just seems to be a massive leadership and risk mitigation failure. How's
Yeah,
that for
so
some-
yeah, so far there's no indication that there's fraud. There's a lot of indication of incompetence. And
Correct.
one thing that we do need to make sure our listeners understand, and you touched on this, is that Silicon Valley Bank is not a typical bank. It's
Yes.
not a consumer bank where, mom and pop put their savings accounts.
Yes.
This bank catered to Silicon Valley companies.
Correct.
And because they worked with the venture capitalists, they were looking for those unicorn companies, as they're called.
Yes.
And I think it's important to realize that there's a reason these companies are called unicorns, and it's because unicorns don't exist. I mean, we've had unicorn companies have gone public through SPACs and IPOs, and 90% of these so-called unicorn companies trade below their IPO value. So the venture capitalists are able to get their money out and they make money, but the investors are screwed because they end up losing money on the investments. And these are the companies that Silicon Valley Bank focused on.
Yes, that was their core clientele. That was their niche. It was a very profitable one for a very long time. But with the Fed aggressive rate hikes and the slowdown in venture capital activity, and a lot of these companies are burning cash at a pretty good clip, meaning that money deposits were not flowing into the bank like they probably modeled. And instead, they saw some outflows. I'm talking about separate from the outflows related to the run. I'm just talking about normal operating, given the economic situation. It turned out they were very fragile. And the regulators, I know there'll be lots of talk from the Biden administration and the likes of Senator Warren about we need more regulations. We need more regulations. But I think what will be revealed for those that pay attention is that the regulators were asleep at the switch. There were plenty of regulations that could have allowed the regulators to influence what the bank was doing, and they failed to act. So maybe new regulations might be needed, but like is often the case, the regulators had tools at their disposal. They just didn't use them. And the leadership at the bank, the people that are charged with managing the money, were epically bad at their jobs in this instance.
And in some cases, there was no one responsible. I have not been able to verify this independently, but my sources have said, most banks have a person or a department that is in charge of risk assessment. Yes. Silicon Valley Bank did not have this. Silicon Valley Bank instead went whole hog into the woke Silicon Valley environment and focused on things like ESG, focused on diversity, and ignored the fiduciary responsibility they had to their depositors.
Yes. I think what I believe is that they had that open risk position, which was an outgrowth of regulation after the Great Recession back in 2008 and 2009. They had that position open for almost a year. I think recently they filled that position, but very recently. And it is crazy that a bank, especially when you're in this inflationary environment, coming out of COVID with everything going on, that you would not fill that position for almost a year. And this is a political spin on it, but the risk folks that did have a public persona seem to be, I emphasize, seem to be much more focused on diversity, inclusion, equity, woke type topics, which is all well and good perhaps, but your core job is risk management. to protect the bank, to protect the shareholders, protect the investors, and it's a complete failure. And that's going to have a lot of repercussions for anybody involved in that bank. There's a lot of victims, including the employees, mostly who did nothing wrong at the bank. A lot of negative repercussions. So it's sad. It's sad for everyone involved.
Yeah, there's nothing wrong with examining these issues of diversity and ESG, but you're a fiduciary, you have to do that first, then you move on to the other issues. Now,
Well
you mentioned the regulations that went on in the wake of the 2008 bank meltdown. And I think that's a good segue into the second bank that failed, which is Signature Bank out of New York. They had a very similar clientele to Silicon Valley Bank. What makes Signature really interesting is that they were actively lobbying for these regulations to be pulled back. And their chief lobbyist was a member of their board of directors, and it turns out to be Barney Frank, who was the co-author of the Dodd-Frank Act, which put the regulations in place in the first place.
Yeah, I mean, this speaks to the larger issue, this cozy relationship between lobbyists and politicians and former politicians. I think you can make an incredibly strong case that this does not serve America's interest generally. And in this instance, you just think of the perversion of Barney Frank, who often talked about regulatory strengthening for the financial system, pretty liberal Democrat, for a long time, was the architect of the Dodd-Frank. Once he leaves office, he doesn't just retire and take up golf. He instead becomes a lobbyist and a board member for a bank and tries to get what he advocated for when he was in government, to have them loosened for his bank and other banks. And it's part of the reason why Signature Bank failed. This loosening of the regulations is, at least in part, a reason why the bank failed and is now under FDIC receivership.
And it's also important for people to realize that regulations, that's the minimum. The board of directors is actually responsible for making sure the bank operates properly. Even if the regulations were loosened, they still should have had their hands on the wheel, making sure that they were solvent and that they were acting as fiduciaries. And yet they failed to do so. And again, you shouldn't have to be regulated to do the right thing in this case.
Yeah. Yeah. Again, you bring up another larger issue in the country, that companies have boards of directors, but in the vast majority of instances, they simply rubber stamp what management wants. They do not hold management to account. They are not critical enough. They just kind of go along with the program. And if the program works, hey, there's no harm, no foul. But boards are supposed to help prevent these type of failures by holding management to account and providing scrutiny, not adversarial scrutiny, but scrutiny nonetheless. And that really doesn't happen much. The board, they get big fat paychecks, they get, nice trips, they get the accolades, the prestige, the sex appeal of being on the board, but they don't necessarily do a lot of the hard work. And in this case, that is one of the many reasons why these two banks we're talking about failed and have put in play this risk of contagion in the financial system.
Right. Now, the banks failing have also set up a little bit of a conflict, because the inflation numbers came out today, and
Yes.
we are up 6% year over year, 0.4% month over month, which is what was expected. It's lower than it's been, but it's still miles away from the Fed's target of 2% inflation. So now the Fed is caught between a rock and a hard place, because they need to raise rates to deal with the inflation, but they don't want to cripple the economy more due to the banks failing.
Yes, I have in previous episodes of Wallet Watch mentioned my thinking that inflation would come down faster than a lot of people were bargaining for. And I think this number continues to reflect that thesis. Back in June of last year, inflation was at 9+%. In September, it was well over 8. November, it was 7+. December, it was 6.5. January was 6.4. Now it's at 6. I think, differing from your view a bit, 6 is not a good number, but the trend is your friend. And the trend is very reliable right now that it's coming down. Additionally, this bank implosion, SVB, and the others like Signature to a lesser extent, is widely considered deflationary. So this will help bring down inflation. Now, it's a terrible way to accomplish it, and there's a lot of victims that'll be left behind. It is disinflationary, though. So the Fed has already had a difficult path of trying to thread the needle to get inflation under control, raise interest rates, but minimize the economic damage, which is not an easy task. Well, their task has just gotten much, much harder, because this inflation number today, that 6% is a good number. But Eric, I would submit to you and your listeners, it's almost irrelevant because so much has changed the last couple of days that this is almost the epitome of old news. What's going to happen now with this? How disinflationary is it, if it is at all? There's a lot of calls that say that the Fed may not even raise interest rates like originally forecasted when they meet later this month. I think it's March 22nd. And that this will greatly impact the Fed rate hike cycle that they've been on. So they really have a difficult situation. But let me also, while we're throwing around blame, and of course it's easy for me to shoot my mouth off and complain about regulators and bank management and stuff like that, but let me point one more out just that kind of sticks in my craw a bit. Just last week, Chairman Powell was interviewed or questioned or came before the banking committee in the Senate. I don't know if you saw this or not, but one of the questions that he got, I forget who asked it. It might have been Senator Cruz from Texas. But basically the question was, is there any systematic risk in the system given the high interest rates and the fast rates they went up? I'm paraphrasing. Yeah. And Powell resolutely said no. And then like 48 hours, you have the epitome of a systematic risk coming into play with the failure of the 16th largest bank in the country. How is it that the chairman doesn't have any sense that there's the risk of contagion, that there's systematic risk that's coming from the high interest rates? It's not that I blame him for that, but isn't it a little upsetting that the chairman 2 days before doesn't see any signs of this? You liken this to the federal chairperson in the lead up to the Great Recession saying that there was no issue in the mortgage market. I mean, just grossly wrong. And that's like I said, that irritates me that this happened just 2 days before. And then, of course, at the same time, our Secretary of the Treasury, Janet Yellen, a day or two before this happened, is in Ukraine. Why the U.S. Treasurer needs to be in Ukraine is beyond me. But this is what had happened right hours before this happened. It's kind of doesn't inspire confidence, Eric.
No, it really doesn't. It looks like our leaders have, taken their eyes off the road. They're not quite focused on what they need to be focused on. And in fact, we've seen Biden came out yesterday morning with a statement saying, the depositors are going to be protected in full, but it's not going to come at the expense of the taxpayers. Well, the FDIC only covers $250,000 per account. These accounts were millions of dollars. That money's got to come from somewhere. And if the FDIC isn't set up to cover it, it's going to come from the taxpayers. So yes, this does look like they're setting up another bank bailout, and people are not going to be happy about it.
Yeah, it is a difficult thing. To be fair, you know, they're going to try and twist around whether it's a bailout or not. But it's not a bailout in the sense that the investors in the bank are not going to be backed up. They're going to get wiped out. Anybody that loaned money to the bank, anybody invested money in the bank because it was a publicly traded company, they will be wiped out. The executive team will be let go, no severance, no golden parachutes, I don't think. So, you know, to that extent, it's not similar to the bailouts we saw in the Great Recession, where money was thrown at the banks and the people that blew it were able to stay in charge and not really pay the price. But it is a bailout in the sense that they appear to be backing deposits above the normal $250,000 limit, which in this case, as I said at the top of my discussion notes, is over 90% of the accounts. They're going to back that up. Now, this is a complex issue, and I could see both sides of it because tech is the innovative heart of this country. It adds to the dynamic aspect of the economy. And to have companies, you know, you think about it, the person that, let's say, just raised money, we're not talking about Apple and Google here, but just raised money. And then they say brought in $10 million, and their venture capital handlers had said, put the money in Silicon Valley Bank. Do you really want that company to lose the $10 million? And the people that invested in that, do you really want them to lose the money? Now, there is the case to be made, buyer beware. They chose the bank, you know, tough on them. But the repercussions of that, Eric, the repercussions of these fledgling tech companies to blow up this part of the U.S. economy is not a good idea. Yet it's also not a good idea to have them get away scot-free and to back all this money up and blow past the FDIC $250,000 limit, because that means basically that all bank deposits are guaranteed by FDIC by fiat across the system, which creates moral hazard. What's the penalty for taking on risk or mismanaging money or not doing your due diligence if everything is backed up? I don't have a clear answer. This is tough stuff, but I do come down on the side of backing up the depositors in the bank who really didn't do anything wrong. I think seems to be the right thing. But there have to be some ramifications in the system somehow. But I don't think these fledgling tech companies, as much as we like to dislike the quote unquote elite in Silicon Valley and the venture capitals, the smartest people in the room, I think it's probably better policy to make these folks whole. That's kind of where I come down.
Yeah, and that makes a lot of sense. I think what concerns me is Kevin Leary's recent statements, because these companies based in Silicon Valley, based in New York, and Kevin Leary, who our listeners should know, is, you know, from Shark Tank, came out and basically said Silicon Valley and New York are uninvestable at this time. So we're not putting money in those pie in the sky tech companies of yesteryear that we're going to push back the push the economy forward and improve all of our lives. These are, you know, uninvestable companies that, you know, they're doing tech for the sake of doing tech. So we're going to have to see how this all plays out. It's not what it once was, and we're pretty much in uncharted territory on this one.
Yeah, and the changes from this, good, bad, and indifferent, the ones that people want to purposefully change, and the unintended consequences will be profound. This is something that may not feel like it affects you every day in your normal lives in Connecticut, but this whole episode and how it plays out will have terrific repercussions for the economy and the financial system moving forward. This is big topic.
Well, you mentioned it may not affect your day-to-day in Connecticut. In fact, Connecticut Innovations, which is a public-private partnership of a venture firm, has 20 companies that were banking with Silicon Valley Bank.
Oh.
So it does actually affect all around the country. Pension money is invested in these things. So we're going to see what comes out of it all. And that's the raw naked truth. Thanks for being with us, Chris. You can catch every episode of Raw Naked Truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and other platforms that respect freedom of speech. We'll see you next time.